research seminar is presented by our very own Athena Petropoulou, and as quite a number of you know, those intern on SOAS have definitely met Athena, I know, but also Athena actually joined us after the in 2020. So because of the lockdown, maybe you haven't met face to face. So Athena is a postdoctoral research fellow at the Center for Global Finance here at SOAS, University of London. She joined in 2020 under the AXA Chair in Global Finance, and joined us from the University of Bath. And it's a pleasure to see that the former working supervisor is also overseer, is also with us. Indeed, thanks for joining us on this. But Athena has core research interests in the area of banking, where she's been investigating credit risk, liquidity risk, efficiency and competition across a number of banking models, for example, community banks. In addition to the research projects previously done at the University of Bath and the University of Kent, she's actively involved in a number of projects in the Center for Global Finance. And this work, which is jointly with me, derives from one of these projects. In fact, when this work was started, if I could say briefly a couple of words about the work before asking Athena to take over. The work started as a flow of funds, or estimating a flow of funds model that encompasses a number of OECD countries, which we can think of as the engine of the global economy, and which provide the largest contribution to growth, especially in recent years and during the pandemic. So the whole idea was that if we can understand the flow of funds as the intersectoral flow of assets and liabilities across the across households, across banks, across governments, and the rest of the economy, then we can see whether the patterns that change, especially the holdings, whether these holdings are by households or companies. But in this case, the focus is on the holdings by households. The flow of funds is a very well-known model, but what makes it specifically interesting in this case is the derivation of asset demand equations from the flow of funds framework. And it's these asset demand equations that are estimated in this paper, and especially trying to understand what assets do households hold in their portfolio, and what are the decisions that induce these households to change, say, from equity to bonds, or to cash, or to deposits, or to loans, and so forth. And in particular, the fact that the work, which has involved quite a number of Nobel Prize winners, took place before the innovation of FinTech. And we want to see whether FinTech actually is going to change, or is likely to change the patterns of portfolio preferences. And okay, so after those, it's work in progress, but after that short introduction, let me not spoil the fun of Athena in going through the paper. Athena, the floor is yours.
Thank you, Victor, and thank you for your introduction. I mean, I couldn't have asked for a better introduction for this paper. So the title of the paper that we have been working on is Financial Innovation and Household Portfolio Preferences, Evidence on the Impact of FinTech on OECD countries. So this is a joint work with Victor, and as I said, it is a work in progress. So of course, any comments, suggestions, will be more than welcome. So a roadmap of the presentation today. On the introduction part, I'm gonna talk about the motivation of the paper and why we think it is very interesting to look in this research topic. I'm gonna go through the flow of funds framework and the almost ideal demand system of equations. Then I'm going to present the empirical model, the data and the variables, and some preliminary results that we have so far. So to start with, as Victor already said, there have been many papers that examine the demand for money and for other individual assets. However, under the flow of funds framework, finance is at the center, and we are interested on how assets are distributed across the main sectors of the economy. So across households, firms, banks, government, and the rest of the world. So flow of funds has been around for more than 50 years, generating a number of Nobel Prize winners such as Lawrence Klein, Richard Stone, James Tobin, and others. Now, under the flow of funds framework, you can have studies that incorporate all sectors under one study, and at the same time, you can have studies that are a single sector study. So basically, in the second case, you are looking at the assets and liabilities that a sector holds, and you try to understand why they hold them. So the main reason has to do with price changes. So we're looking at price elasticities. Now, the reason we think that it will be interesting to review this, to renew, the interest in this type of research has to do with the role that FinTech is playing in the past few years. So FinTech has given rise to a new features that could affect the demand for certain assets. And we think it is important to understand the role that FinTech plays in the demand for assets for the household sector. So by doing this paper, we aim to fill this gap. Okay, so why FinTech? When we talk about FinTech, basically we're referring to financial technology. So it is a growing industry that transforms the provision of financial services, is giving rise to new business models, new applications, processes, and novel products. So FinTech offers innovative solutions for the entire spectrum of the financial services value chain. When it comes to household, according to the Bank of International Settlement, FinTech impacts households' balance sheet mainly through 3 channels. So channel number 1 is through new forms of payment. Channel number 2 is new forms of lending. And channel number 3 is through new investment opportunities for households. So the first channel, which has to do with payment technology, basically because of FinTech, we are seeing that households are moving away from holding cash and they're turning to digital payments and mobile money providers. For example, in the US, the use of cash accounted for nearly 20% of the payments made in 2021, which is actually down 7 percentage points compared to 2019. In the UK, cash were used to pay for less than 20% of the sales value in 2019, and close to 60% of retail sales were made using a debit card. Also in 2019, almost 20% of the adult population in the UK registered with some sort of a mobile payment application, such as Apple Pay, Google Pay, Samsung Pay, etc. And as a result of COVID-19, we've seen that people are making fewer in-person payments because of restrictions, because of health concerns. But these changes in payment behavior have been accelerated due to the current pandemic. Now, the second channel through which FinTech affects household portfolio decision is through transforming the lending process. So FinTech has challenged the role of banks as traditional financial intermediaries, and we've seen in the literature that there seems to be a substitution effect between FinTech lenders and traditional banks. Now, the size of the FinTech credit market varies significantly across countries, with China being the largest player here, followed by the US and the UK. To give you an idea of the numbers behind the FinTech lending, so in the US, 36% of personal loans were made by FinTech providers, and around 10% of the total mortgages made in 2016 were originated by FinTech lenders. In the UK, FinTech credit accounted for 15% of the lending flow to consumers and SMEs. So FinTech lending appears to be highly relevant for consumer and SMEs. The evidence that we have so far on the impact of COVID-19 on digital lending is that actually COVID-19 has had a negative impact on this sort of lending. And the third channel through which FinTech affects household portfolio decisions has to do with increased investment opportunities for households. So the digitalization of finance has the potential to expand the range of investment opportunities to new asset classes and securities. Here we can think, for example, robo-advisors, which provides an online automated portfolio investing service with a substantially lower cost, shorter time, and also lower starting account sizes than traditional investment advisors. Crowdfunding creates access to new investment opportunities and new products that could translate into portfolio diversification benefits for households, mostly because holding crowdfunding investments is regarded to be less correlated with traditional investments such as bonds or shares. So FinTech offers households with portfolio diversification benefits. Now, a review of the literature. Flow funds analysis was introduced by Coblan in 1952 and was later implemented in official statistics. first in the US and later in the United Nations system of national accounts. So it is useful to distinguish between flow of funds model and one sector studies of flow of funds. So sector studies are essentially building blocks of a flow of funds model. But the central characteristic of a flow of funds model is that it is a general equilibrium model, and therefore it explains the flow of funds and the movement of interest rates jointly under one consistent framework. Now, sector-specific studies are more numerous than flow of funds model studies, but have less to say about interest rate determination. Among these studies are integrated portfolio and expenditure models, and another approach is to treat asset demands as analogous to consumer demand system and utilize flexible functional forms to specify demand functions, like, for example, the paper by Baron Cuthbertson 1991. Now, as I said, in this paper, we are estimating a flow of funds model for the household sector within the almost ideal system framework. And we are focusing on the household sector, and we want to see the impact that FinTech has on the demand for specific assets for household, and also on the substitution between different assets for households. We are focusing at the main players here. So we are focusing at large economies which shape the global economic developments. So we are looking at the UK, EU, US, Japan, Australia, and China. Now, with this paper, we seek to make at least three main contributions. The first one is to offer a new interpretation of the demand for financial assets by households in the era of financial innovation. The second one, to impose cross-equation restrictions to cover substitution effects between FinTech money and other financial assets. And the third one is to assess the impact of COVID-19 on household portfolio preferences. Now, to give you an overview of the flow of funds framework, this table shows a kind of simplified version of a flow of funds matrix. So the columns are the different players in the economy. So we have financial services, we have government, household, companies, and the rest of the world. And each row is an asset that these players hold. So basically, flow of funds arise from transactions that take place within the economy, mainly involving the sales of goods and services and the exchanges of assets and liabilities. These transactions generate a flow of funds from one sector to the other and from one agent to the other. And they're typically presented in a flow of funds matrix where each row is an asset and each column a sector. Now, each cell in the matrix shows a net purchase or sale of an asset by sector, which can then be explained using asset demand equations. And each column sums to the sector's net worth. so the net acquisition of financial assets. Now, from the flow of funds matrix, we can the flow of funds matrix can be transformed into a flow of funds model, and we are assuming that each cell in the matrix contains a variable that can be explained with an asset demand equation, and explanatory variables are interest rate as well as other variables such as expenditure or binary variables indicating a certain periods of time, etc. So in this paper, we adopt the almost ideal demand system by Titon and Molbert, 1980, to explain the importance of FinTech in the demand for assets for households. To give you a background on the model that we are using, the almost ideal demand system model starts with the cost function. The P stands for the prices for each asset, and the U is the utility level. And now the H model, the reason why we're using the H model in this study is because the H model is flexible enough to enable us to model the impact on household behavior of innovations in FinTech. So here you can have auxiliary variables, which is the second equation here. So the H account for auxiliary variables, which in our case refers to the FinTech proxies. Now, from the cost specification, we can derive demand equations, which are basically asset share equations. So the dependent variable here is the asset share, and the independent variables are the price of the specific asset as well as the prices of the rest of the assets, explanatory variables, and also the net worth. And variables here are expressed in real terms. So this is the empirical model that we are estimating. So from the asset share equations that we saw before, we are specifying a system of simultaneous equations that can be estimated with a sure model, where the dependent variable is the share of its assets. Here we're looking at currency, at deposits, at government securities, equity, so stocks, and loans that the households have. And the independent variable, so each of these variables is regressed on the price of itself, the prices of the rest of the assets, FinTech proxies, and the net worth. So on the measurement of the variables, so the price of currency is 0, the price of deposits is the deposit rate, the price for government debt securities is the government securities yield, price of equity, the rate of return for the main stock index for each of the countries that we have. Like, for example, for the UK, we've used the FTSE 100, for the US, the S&P 500, etc., and price of loans, the lending rate. The expenditure variable is captured through the net worth, which is currency plus deposits plus debt securities plus equity minus loans. And then we have included and we have run our models with different proxies for FinTech. Now, the first three proxies that we have used is the usage of internet to pay bills, the usage of mobile phone or the internet to access a financial institution account, and also the digital payments being made in T-1. However, since our data goes back to 1990, we can assume that using the internet or using a mobile phone would not be relevant in the years prior to 2010, 2008. So for this reason, we are also including additional FinTech variables, for example, the credit card ownership, debit card ownership, and the number of ATMs countrywide and the number of ATMs per 100,000 adults. Now, when it comes to data sources, so basically we started with the whole universe of data that we could get on flow of funds. And we accumulated data from different data sources. So for the US, we used data published by the Fed. For the UK, data is from Office of National Statistics. For the EU, we use data from European Central Bank. Japanese data come from Bank of Japan. Chinese data are published in Chinese statistical yearbooks. And Australian data come from Australian Bureau of Statistics. And then we use the exchange rate to have our variables expressed in million US dollars. So as I said before, our data goes back to 1990 up until 2020. And for the FinTech variables, our sources is the Global FinTech Database published by the World Bank and the Fed. To give you an overview of the sources and uses of funds for the household sector for each country. So this table here, it shows the mean share of wealth for each asset that we are looking at. So what we see here is that deposits have been the major component in financial assets for the US, the UK, the EU, and for Japan. And actually for Japan, we have a percentage here that is above 100%, which indicates, shows evidence of a round-tripping effect, meaning that money from loans are parked into deposits. Bank loans appear to constitute a comparably higher share of net worth in Japan and EU. So in Japan, it is above 40%. In EU, it's close to 60%. If we have a look at the FinTech variables, so we can see that more than half of the population has used the internet to pay bills or has used a mobile phone or the internet to access a financial institution account. 90% of the people have made or received digital payments. And also we see here that debit card ownership is higher than credit card ownership. One is 80%, and the other one is close to 60%. Now, correlation matrix of the FinTech proxies. So we can see here that a lot of these variables are highly correlated. So in our preliminary results, we have included one FinTech proxy at a time. Starting with a simple model. So this is a model that we estimated without accounting for the FinTech factor. So it's the results from the SOAS estimation. And the dependent variable are the share of currency, deposits, debt securities, equity, and loans. We get an idea of how prices of each of these assets affect on the share of the assets that the household holds. Now, on the results that we have this far on FinTech, if we have a look at the variable that accounts for using the internet to pay the bills, we see here that it seems to have a negative impact on the share of deposits and a positive impact on the share of equity. So this makes us think that people because of FinTech, they have better access to investing. So basically, FinTech has made investing a lot easier. There are platforms like eToro or Robinhood, or even through a Revolut card. You can use these platforms and these apps to invest in stocks, even without any prior investing experience. So it seems that households, instead of parking their money in deposits, they choose to invest their money, and which will result in higher returns than putting their money in their saving accounts, for example. Now, the same result holds when we're using a different FinTech proxy, so the mobile phone or the internet to access financial institution account. Again, the effect on the share of deposits seems to be negative, and we document a positive effect on the share of equity. Now, moving on to the results that refer to debit and credit cards. A result that is interesting here is that credit card seems to have a negative impact on the share of deposits that households hold. So basically, you do not need to hold deposits, because when you're making purchases through your credit card, you're not actually spending money from your account, but instead you're sort of borrowing money from your credit card company that you're paying back later. So you're not need to have this money on your account. And the next set of results that refers to the use of ATMs. I think it's interesting here the fact that there seems to be a negative impact on the share of currency. So basically, people do not need to hold cash in their pockets, because if there's an ATM around every corner, then it's much easier at any time to go and withdraw cash. So you do not need to hold cash in your pocket at all time. Now, an overview of the findings that we have so far. So we wanted to see what drives the demand for cash deposits, debt securities, equity, and loans for the household, and how does FinTech makes a difference in the share of assets that households choose to hold. And it seems that FinTech, in all of its configurations that we have looked at so far, has an important impact on household portfolio decisions. So the use of the internet and mobile phones seem to decreases the demand for deposits, and at the same time increases the demand for equity. The use of credit card decreases the demand for deposits, and the existence of ATMs has decreased the demand for cash. Now, further work that needs to be done is, first of all, to control for the global financial crisis and for exchange rate variability. Also, we want to control for the COVID-19 pandemic and to see how the pandemic has affected the choices that households make when it comes to the assets that they hold. For example, because of social distancing, there has been a tremendous growth in the use of digital financial services and e-commerce. And households, businesses, and banks, they have become increasingly more dependent on digital financial services and e-commerce because of sheer necessity. And we also want to include more proxies for FinTech. The proxies that we have so far covers the first channel through which FinTech affect households, so mostly the changes in payments. And we want also to include proxies that will cover changes in the lending behavior and changes in the portfolio in the investments of households. Now, that concludes my presentation. Thank you very much for your kind attention. Any comments, suggestions, questions are welcome.
Thank you very much, Athena, and we give you a round of applause using the Gizmo in Teams to thank you for going through the paper carefully and clearly and explaining the work in progress. And if I could add a little bit and then open the floor for a discussion, comments, and suggestions. Yes, it's a work in progress. There is a brief review of the literature work which has been done that can also updated be with some of the work that our colleagues and I, especially Chris Green and Tommy Moore at Brunel and Chris Green at Lafobra have done, and Bashar with the chief economist of in Jordan have done in this area. But still, all the work done until today does not factor the role of innovations in technology specifically FinTech and maybe any other innovations, to see that these innovations would dramatically change the household preferences and choices when they are selecting assets to hold and when they are combining the assets to build a portfolio. And basically here we take a number of assets and then the combination of these assets is a portfolio for each household. Yes, in a way, if one was to do this broadly in detail, one would have possibly about 10 asset classes and about 5 liability classes, but you simplifying, say where we have the liability to loans, and that could actually be expanded. So some of this, for example, where we have equities, that equities could be further expanded into some different classes. So there is a possibility of expanding the flow of funds a framework, and then of course that will translate. The flow of funds framework will generate identities, and those identities will then translate into the asset demand equations, and those could be further expanded. Okay. But there is also another aspect that we are exploring, especially when we get stable initial estimates of the pooled work, is to introduce dynamics, because it may really be it's the case that the choices made by households are made not just right in time, but are made after time lag, say after 1 quarter, so we can have dynamics of lagged T quarterly information, so that we can see even how long it takes for for households to change their choices. But much more importantly, also there's an aspect that we explore in the use of seemingly unrelated regression. What is provided here on the 7 tables is a summary of the seemingly unrelated regression equations used. But actually, there are individual estimations for all countries. For example, if you take, say, the demand for equity as an asset class, one looks at the demand for equity in the UK, in the US, in a number of EU countries, and then so then you have that equation estimated, as in the case of previous seminar, across a number of equations. So we can have cross equation restrictions which say that actually the elasticity of holding, say, equity with a change in the return on equity is 0.45 in the UK, but 0.46 in the US. Then you impose a restriction, suppose it was 0.44 in both countries, what would happen in the other choices? So that is that because what households do, that they make choices. They decide to move from one asset and then move into another asset. They still have a portfolio, but the amount of the composition of holdings within that portfolio may change, where, for example, cash, as we saw in this conclusion, cash may be reduced to about 2%, or money put in deposits and equity. Okay, and of course that has changed and may have change with COVID-19 and contactless transactions, especially in the face of COVID-19, households migrating from cash holdings to other forms of holdings. So yes, so I will, at this juncture, I can see quite a generous number of people who have put up their hands. So I will, they have actually, it's in the same order. Thanks, Meng. So it will be Abi Kadir first, and then Jo Marie, good to see you, Jo Marie, then Dak, and then Hong. Okay, so Abi.
Okay, thank you, Victor. Can you hear me?
Yes, we can. I can hear you very well, Abi.
Excellent. Thank you, Atina, also for the very nice paper. My question is just a very small comment on the technique of introducing an extension to the standard AIDS models that you have estimated. Have you considered estimating the standard AIDS system by introducing quadratic terms, because there is an extension of the Ditton-Milbar almost ideal system by Banks, Blandel, and I think Lobel. Therefore, did you consider estimating a quadratic almost ideal system? Because I think demographic factors also are important for demand, as well as a quadratic term on the welfare indicator.
Yeah. I think thanks very much, Abby, and I think that makes the work rich by including quadratic term, and also I think we could interact FinTech with some of the other variables to see the response, how the channel of influence through which FinTech may affect the shares of the equations being demanded. So we applaud your comments. Thank you very much, Abby. And actually, I think your comment also has a broader implications because you see the almost ideal demand system has been applied to goods outside the financial sector, and there has been a lot of recent improvements which have not found their way to financial economics or to finance. So I think we're going to explore those references that you have cited. I don't know whether you have, if you want to add anything, Athena, please go ahead. Yeah.
No, I just wanted to say thank you, Abby, for your comment. And yes, we're right. We are actually now working on the specification of the model. So we're trying different things, and including the quadratic aids should be one of them.
Thank you. Okay. Let's move to Jo Marie. It's good to see you, Jo Marie, who heads the think tank Global Rules for Regulation in Washington, D.C. And I know it's very early morning in your neck of the woods, Jo Marie. Thanks for joining us. Please go ahead.
You're welcome. It's very early for a retired person. But I am fortified by my first cup of coffee. It's a very impressive piece of work. I salute you for your ability to use all those equations. I didn't study Greek, and I sort of panic when I see them, but you explained it very well. I have a simple question. Is your work able to be extended to non-OECD countries?
Athena.
Thank you, Jo Marie. So yes, it can be extended. The reason why we started with these countries, so as you see, we selected only a few countries, is because we wanted to see what happens with the main players. So these are the countries that contribute the most to the global GDP, in the sense that what happens in these economies will set the tone for the rest. Here also, I wanted to add something on what Victor said earlier. Comes the issue of how you synchronize the data, because we are getting data from multiple resources, and it could be that Australia reports more detailed information on flow of funds, assets than China, for example. Or some countries report data on an annual basis. Other countries report data on a quarterly basis. So an issue that we had to overcome was to synchronize the data to be able to have estimation on the pooled sample of these countries. But yes, this is something that can be extended to other countries as well.
Yes, indeed. And if I could add on this, thanks, Athena. And again, Jo Marie, thanks indeed for mentioning that. I think I can guess where the question is going, because I think the extension to the rest of the world or some specific regions would be absolutely helpful from many angles, and of course from regulation, bank regulation or financial regulation globally. That would be absolutely helpful. We started with the OECD countries. We wanted to see to pin down the countries that influence the global financial system to start with. In previous work, we have covered India, because India has very rich data on flow of funds, but we also have covered some African countries. But of course, all that previous work did not include FinTech. To the best of our knowledge, there is no previous work that has integrated the effect of FinTech on asset demand equations. That's to do that. But yes, we shall do that, Jo Marie. I think this is a big long-term project, so some of the work we do will be able to explore the implications for other countries. There is something that when the data was being put together, and quite a number of people in this meeting were involved in the data, construct the database. I can see, and we thank them. I can see Anos here. I can see Jeffrey here. Aisha, Juliet, quite a number of people here were involved. And we had actually wanted to include China. The reason being that when you go into other forms of assets, like for example, at the moment, across the world, China has the largest volume of foreign exchange reserves. Okay, so that would be important, especially as we are going to be introducing in the variable on exchange rates. Yes, I think our next work will incorporate those countries which are outside the standard 7 OECD, like China, for influencing, for leading in some of the indicators like foreign exchange reserves, and then also broadly looking at, say, the regional variations in the patterns of our household preferences. Thank you. Doug.
Thank you very much, Victor, and thank you, Athena, as well for a really great presentation, and also thank you, Jo Marie, for the question as well. Of course, it's very interesting to be able to extend it to developing countries. And I suppose, unlike Jo Marie, I did study Greek as well, and also happened to apply the almost ideal demand system equations for my master's thesis at the University of Groningen. Yeah. I've got some questions a bit sort of, well, partly about econometrics, but partly about economics as well. So one of the questions is sort of, how do you think FinTech should affect these sort of the holding of deposit and different asset classes? Do you think there should be a one-off level effect, or are there also other types of effects that happen? And are these effects should it be linear, or can they be sort of different, so that perhaps at a very low level of diffusion of certain FinTech variables, there may not be that many effects, and also if it's completely diffused, there may not be that many effects, but in between there are rapid effects, and so sort of the bell curve of diffusion, and therefore you suddenly have completely shifting things around completely. And so I was wondering whether, so Abby was asking about the quadratic terms, but you can also think a bit about different types of impacts of FinTech variables, either linear or non-linear, and also perhaps the price elasticities, because that is one of the things you can of course do is think a bit about the cross price elasticities, because you estimate them as well, isn't it, as part of the SURE equations, is that you estimated cross price elasticities, and you could maybe make them depend also on FinTech variables as well, so that there's not only a level effect but also a price elasticity effect that plays a role. And one other sort of question was a bit sort of so those people that haven't been able to access an ATM, and it's particularly think about maybe poorer countries as well, but those that don't have an access may also not have access to equities, or may not hold equities, and so there may be, but those that are financially much more literate are also more interested in holding equity, for example, and playing around with their money as a household. So is there some endogeneity issue there as well that could potentially play a role, so that it's that if there is some underlying sort of financial literacy effect that basically that affects both the FinTech variables and holding equities, for example. So I'm just wondering whether that is something you can take into account. So the questions are really about sort of what are the economic effects that you expect? Are these linear effects causal relationships, or are there lots of other effects that can play a role from the FinTech revolution? That because some would say it's the same with the fourth industrial revolution, and in other cases that you say, well, this is all so very different that everything is changing, or is this sort of a simple one level of effects, and could you test for these different types of effects, the complex and linear effects? But I really love the paper, really interesting. Thank you.
Excellent comments, Doug. Thank you very much. And maybe this is whet the appetite of people involved in this workshop to see that Doug, who is the professor of practice at SOAS, as well as director at ODI, will be presenting path-breaking work next week. So this is the start of our exciting discussion with you, Doug. Your comments are very helpful, especially in pushing us to explain the question of how should FinTech affect the demand for assets, the demand equations. One slide, I think one thing we have in the paper and still to be polished is the theoretical predictions, whereby we take these equations and we have the predictions could be plus, negative, or indeterminate, and we have these tied in to give the predictions based on consumer theory mainly, and for asset holdings. So one thing is that, yes, there is a theoretical counterpart against which the empirical results are interpreted. But you also absolutely true that what we have here are just a impact and the term contemporaneous. But as I mentioned before, it will be we are working on the dynamics, exploring whether it's a dynamic structure, because households need a little bit of time, especially this data is quarterly, so we are looking across quarters. That in quarter one, the deposit interest rate went up, and maybe then households were able to move from cash to deposits in the subsequent period. That catches the dynamics across the asset holdings, and also captures the price, the elasticity effect, the price elasticity effect. But also important to see that what we have so far is based on a very simplified assumption of linearity. But as we quite observed that, it's a very simplistic assumption. The right assumption, even when we include dynamics, would be to explore for the quadratic term. That's consistent with the earlier comment with Abby, made by Abby. And then, of course, that would mean that especially if we have interaction terms, we can explore the diffusion you mentioned, especially the diffusion of various forms of fintech. We actually have, in our view, we have a limited definition of fintech, because the fintech dimension, especially for households, has changed. So for example, in the last 3 years, there's been active holdings of cryptocurrencies, especially when we are talking about OECD countries. And this we do not pick up because we found the data a little bit tricky, and the data had to be believable and from a given source. But I think with the right kind of data, we could explore that. And especially for cryptocurrencies, we could see things like diffusion. Yeah, okay. Another term is a household holding, foreign currencies. In other words, a residents of UK holding dollars. Okay, that's a kind of foreign exchange holdings by households, which is common because individuals in one country may have may hold other currencies or may have accounts outside the country of residence, which has been in vogue since 1992. So we would possibly want to explore these and see the diffusion of interaction terms with the fintech. And yeah, the endogeneity issue is something we thought about. But you see, the estimation of when we estimate 6 equations here, we're actually estimating 7, but we don't put the 7. The 7 one is about not worth. But in flow of funds modeling, you actually, because basically you are working with identities, you estimate the full equation of -1, because the other equations can be obtained from actually from looking at the other estimates. But we want to see also endogeneity. In fact, there is a table that we normally use to say clear endogenous, clear exogenous, and then those which fall within the endogeneity. And it's so straightforward now, of course, test for endogeneity and where we suspect it to instrument it with something outside of an asset demand equation. Something may be, something that may be with the labor or land or any other important factors in a global economy. But thanks very much, Adak. Absolutely helpful comments.
Victor, if I can
Yeah, please
add
go ahead.
something here.
Yeah.
So is that fintech is not one thing, right? So fintech has so many dimensions. So we can think that ATMs was fintech. I think there's a paper by Thakor 2020 at the JFI which suggests that until 2008, ATMs were part of fintech. And now you have new types of households investing in cryptocurrencies, as Victor said. So we were really trying to think of as many ways as possible we could use to capture the effect of fintech on household portfolio decisions. But of course, it always breaks down to data limitations and what kind of data is available. So, for example, something like the market capitalization of cryptocurrency could be used. But yeah, I think it has to do with what kind of data are available and different ways that researchers have used so far to control for fintech.
Thank you very much. A very timely response and addition to that, Athena. Thank you indeed. Once again, Adak, very, very useful, helpful comments. Hong, and then after Hong, I'll call upon Jaideep.
Yeah, okay. Thank you very much, Athena, for the presentation and for the work, and especially after my lecture at 1 o'clock. So I took my lunch together with this nice piece of research, and that is really nice. So some of my questions actually have already touched upon by previous comments. So I think my major question is about the SURE model. I'm not familiar with flawed funds and this model. I have never used this model myself, but I ask myself a question. If I look at my demand for a particular asset, is the price only the determinant in my equation, or are there any other fundamental factors? So, of course, I'm not sure about this SURE model, but the fundamental issue is there. So I only see the price of all other assets, financial assets. You do need others, the fundamental determinants of the demand for assets. And I think that is a very a major issue for me. And unless you can justify why you only need prices of other financial assets, and then you plug in your FinTech indicators. So that's my major question. So what is the economics? So at least I'm not convinced about that. And that is really related to the problem of endogeneity, because we already discussed this. You know, all the assets, all the prices for different financial assets, they are basically, to me, they are highly correlated with each other. So what are the central, price that you are, looking at? So obviously there are endogeneity problem here. I do not know how to solve that. And my second issue is on the countries that you included. And now I think I became clear that you did not include China. However, I heard something that you had some statistics from China. So it was not that clear to me. Even without China, I think there is a differences in terms of the country characteristics. So how do we consider that? For example, Japan probably is a little bit more advanced in terms of FinTech, et cetera, et cetera. So how do you consider this type of country-specific characteristics? And for example, the level of FinTech development and et cetera. I didn't see that thing in your model. For example, do you have fixed effect in this SURE estimation? It's not clear to me. So that's something that I'm concerned about, but it's a very good try and in terms of the direction. So I really hope you can produce something very, comprehensive. Thank you very much.
Thank you very much, Hong, and we appreciate the instant move from the end of your lecture to the start of this session in about 2 minutes. Very much appreciated. Your comments, are very rich and absolutely helpful. Let me say something, and then I will invite Asina to add on. Your first comment on the seemingly unrelated regression equations by Zerna in a path-breaking econometric 1962 paper, and which has, since then, of course, been modified, is important because, unlike any other pooling methods, it enables us to be able to impose cross-equation restrictions and therefore compare the elasticities across a number of countries, or the elasticities on or the coefficients of, for example, the response of FinTech to the demand for loans as compared to the demand for equity. And so it's a unique model. I think we should, in the paper, put an appendix in explaining what we do and how the inversion of matrices, the matrices of the in the SURE model allow for computing the value of the Kronecker product, and therefore giving assurances that there are stable cross-equation consistencies in the estimation results. So we're going to do that, and it's going to be helpful. It's going to, I think, shed a lot of light in terms of how the SUA model is applied here. Thank you indeed for mentioning why we do not reflect the control variables that are associated in the financial economics literature with explaining, for example, the demand for equity or equity holdings, or bond holdings by households, or even the demand for loans, or even the demand for money, which is cash. And so there are some of the traditional factors, some of the control variables, so those covariates would be helpful, and we will incorporate the covariates. And also one can see, again, how the model works with covariates and without the covariates. As usual, when we have these control variables, which are very well known in the literature, that's why the control variables, in the literature, the important story is about those variables of interest. But still, it's true that we still need to account for how the controls behave, and we'll be happy to have them so that we can explain the asset holding preference of households in taking into account the standard conditional factors or the control variables. Yes, we had China in the data. And I think, as I mentioned before, it's a very important country because in terms of what is influencing global developments today, you can't rule out China. I think we have full data for China, but I'll leave to Athena to maybe can. Yeah. Thanks, Athena, if you have something to add.
Yes, Peter, if I can add something here. So thank you, Hong, for your comments. Now, with on your first comment, so of course, yes. So we are when we're estimating the model, we are interested in price elasticities, but also in the literature is very common to include a variable for expenditure and a variable for exchange rate variabilities also in the equations. So this is something that I think needs to be included in our model as well, apart from prices, as you said. Now, when it comes to China, as Victor said, we couldn't rule out China because it is a major player. One issue that we have with China is that flow funds data from the statistical yearbooks for China are on an annual basis, whereas for the rest of the country, they are on a quarterly basis. So to overcome this problem, we didn't want to pull China, make the data from annual to quarterly and pull together with the rest of the countries. So what our action plan is to have China as a robustness under the robustness test with annual data. So this is the issue that we had with China, unfortunately.
Yeah, thanks for adding this. I'm not sure whether you are one of the people we contacted, Hong, but we contacted a number of scholars looking for this.
They provided you with the flood fund.
Yeah.
My pleasure.
We did reach out to some people, and eventually we confirmed that China doesn't have quarterly data. As usual, you can always do some algorithms to generate, but the criticism is always that when you convert the annual data into quarterly using this algorithm, you are not creating any new information. Okay, so you actually only get the information that is in annual observations, not quarterly. But as Athena mentioned, I think we have a table in which China is included. Maybe synchronizing all the other countries with the annual observation, still there is, I think there would be enough degrees of freedom to asymptotically estimate the equations, especially within SURE, because a SURE is not profligate of the degrees of freedom. In other words, it enables you to actually save some degrees of freedom. So we can do that on annual data and estimate the demand equations with using annual data with China's annual data and the annual data of other countries. But thanks for mentioning that particular point. Let me see. I think we have yes, Jaideep.
So,
yeah.
Athena, thank you so much for the presentation, and Victor, thank you as well. And so, and nice to meet you, Athena. Actually, I don't think we've met in person.
Yes, Jaideep is is a new member of in SOAS.
Nice to meet you too.
And I think with the end of the with the face-to-face meetings, I think Athena and Jaideep should be able to have a cup of coffee on campus very soon.
Yes, hopefully, yes. So, so I have a couple of things. I'm just basically following from the previous comments. I'm thinking about the time dimension really. So, so one of the things that that I was not clear about was like, this is just a clarification really. When you think about things like variables like using mobile phones to pay for stuff, what is the sample period that you use there? Because otherwise you might end up having like two different periods when mobile phones were available to do these things and a period when they were not at all available. So you might have a different kind of breakdown in your sample then.
Yes, you're right, Jaideep. Actually, because, for example, data on the usage of mobile phone, etc., they start from 2011. So they start at the later stage. What we could do is to have estimation on different time periods. Maybe this is something that we can consider, because for example, for example, ATMs or credit cards can be relevant for the years before 2010, and the usage of online payments and mobile phone to access your bank account. Because we have this data from the FinTech databases, they start at a later date.
Okay, perfect. So just, I mean, from that sort of time dimension perspective as well, I mean, basically, these a lot of these effects seem to be cumulative, right? So, so we have this whole issue of, as ATMs, like as you talked about diffusion and stuff like that, so it's like basically having FinTech as a variable. It becomes a bit complicated because of this time dimension, also because of the fact that the same people, like, when they initially use it, it may still not be that convenient. They can do more things as time goes on. And so these variables may not necessarily, they're great proxies, but they may not sort of capture that cumulative effect of, especially because of the changes in valuation of assets and stuff. So that's, I think, something Hong mentioned as well, is like this whole thing about, when, what happened with things like GameStop, right? So valuation changes the numbers significantly, at least for short periods of time, quarterly dimensions. So relative prices become a big question mark in that context. So I was just thinking that, like, part of the story, because of these questions, seems to be, to me, is like when you're bringing FinTech into the equation, is to say, oh, why are we what the question, one question you're asking effectively is, when you have access, do you change your behavior, right? So do you optimize your portfolio differently when you have the facility to do something different, which is what FinTech is provided. So a way of checking that might be like going the other way. So when access is taken away, rather than when it's given to you. And so, like, what's happened in China last year with the last couple of years with the regulations, there's been a massive sort of clampdown, right? So I've asked myself this question: the $250 billion worth of assets have disappeared, right? Because the whole FinTech sector was just made to just suddenly stop, like all these big organizations, Alipay and so on. So where did those assets go? So in a flow of funds model is in a perfect way to try to maybe explore that question, right? So to ask the question the other way around. So when this stopped, what happened to people's portfolios really? And so in a way, maybe that might answer your question. The first question, like how do people want to use this, is because when they can't use it, what do they do, right? So I mean, going backwards in a way. So I just thought that might be something to think about. I'm not sure how you would formulate it exactly, but it's probably worth exploring, kind of because that, you know, it helps you address a lot of causality, endogeneity, all those issues directly, because you have an event which is like very clearly defined, and it's not cumulative. It's actually just stops something from happening suddenly. So.
Yeah, thanks very much, Jaideep. I think this is a very, very rich contribution and idea to look at the time dimensions. In actual fact, there is already a work that I've done with the Timios, who until recently used to be another postdoc research fellow at SOAS and is now at the University of Manchester. We have a working paper in the Center for Global Finance working paper series, and figure 1 actually gives the chronology in how these innovations have been taken. So it's easy to pinpoint the time of change on all these dimensions kind of globally. This paper is also forthcoming in the International Review of Financial Analysis. So this table would give us that, you know, to pin down, you know, what happened across the. Actually, it goes back to about the primitive forms of fintech in 1817, and then up to the current super tech forms of fintech. It is the question of how to investigate this exhaustively. Yeah, we can pin out the time dimensions, okay? Now, when it comes to investigating it sufficiently, I think this is where I would be scratching our heads a little bit. Maybe the almost ideal demand system type of asset demand equations may not sufficiently capture that effect, even when you introduce the dynamics. In the cumulative effects, maybe that, you know, all variables in the models change, or the variables are changing. So the dynamics from time to time, every quarter they change. But of course, the change we're interested in is that change you're mentioning, especially in the FinTech dimension. But the way the question is posed maybe would be one that can be done. It almost sounds like an event study type of work, whereby an event study, you know, and of course, you know, I refer back to that wonderful paper by Craig McKinley in the Journal of Economic Literature, Event Studies. It captures sincerely how all event studies should be done. Such a methodology, as Craig McKinley mentioned in the Journal of Economic Literature, will very competently hammer this question. And it will maybe the case that Jaideep, you are pointing us to another direction. You know, we try to capture the timings, the time dimensions, but to be very precise and show the impact and the distribution. I think we could do this in an event study. Well, the event study, in a way, the structure of it is that it is on cumulative abnormal returns. We basically have the cumulative abnormal returns across time. But it may well be that the variables generated from a flow funds model, generated from asset demand equations, could provide the way, because, you know, the cumulative factors is just looking at equities, okay? But we could be looking at other assets. I think this is very inspiring. Actually, we could be, yeah, we could be looking at assets, could be looking at loans, we could be looking at bonds, okay? And that could be an interesting thing. So yeah, building on an event study into these equations is something that we're going to think about. I don't have an answer on top of my head, but I can see that you are pushing out to think, you know, creatively, and why not? That's what seminars are about. Thank you very much. I don't know if you want to add something, Sina.
No, not really, Victor. I just wanted to say that I think Jaideep's point of view is really interesting. So it's one thing to ask how do households behave when they have this kind of fintech solutions available, but it's a very interesting question to ask also what happens when they could have it available, but they don't. So when it's taken away from them. I'm not sure how this can be written, I mean, in terms of the methodological stuff, but it's definitely food for thought.
Excellent. Yeah. Good. Yeah. And I will be updating you of a couple of courses, JD, on how how we decide to deal with this, and maybe it will be another paper. As I said, maybe it will be another extension that invokes a event study methodology to see that. And because those changes actually are very dramatic, as you mentioned. Yes. In that chart, on that working paper, we have kind of dramatic scenarios of some of the changes. I can see, Jo Marie, you still have your hand up. I don't know whether there's another follow-up comment or this is a legacy hand. Jo Marie, you are free to come back, of course, Jo Marie, if you have an additional comment.
No, I have no other comment or question.
Okay, that's fine. That's absolutely fine. Any further comments, contribution? This is a great work. And now, yeah, I could possibly use this opportunity to add that when maybe Athena, you may want to go to the flow of funds table that you started on the slides, and I just want to mention something which people should be expecting in June of this year. The last presentation in the Center for Global Finance series. Yes. Okay, so you see what is being estimated in this paper is the column number 4 on households. Okay, so it's actually it's estimating the demand equation for the household sector. Okay, in column number 4. And Xiaoming and other scholars at the Christian Jiantong University in China, Christian Jiantong Liverpool University in China, and a couple of other colleagues there. We are working on asset demand equations for the company sector. In which basically the equations end up being the asset demand equation being able to incorporate the three decisions by corporates, by companies. As usual, we know the three decisions are, first of all, capital structure, which looks at the way equity over debt holdings, the dividend decisions, which looks at dividends, and the investment equation, which looks at investments. And so by being able to look at the asset demand equations for companies, we are able to incorporate all these three decisions in a single framework. And this is then estimated taking into account two big changes. One is, of course, the FinTech change, and the other is climate risk. So climate risk is integrating this and the way it has influenced the behavior of companies. And this is done both with the conventional methods, conventional econometric methods, and then with the machine learning methods to see whether machine learning applications generate a better insight into that. But that paper will possibly be available at the last seminar in the Center for Global Finance series. What we haven't been able to do is to look at a government behavior, which would be another dimension, or a bank behavior, which would be the second column. So that is the bank behavior, and the government behavior has not been explored, but we hope that can be done in future work. Okay, I don't see any other. Let me look at the chart. In the chart, I think I had put in a couple of measures of comments, but this I was able to mention in the course of the discussion. Meng, do you see any of the comments that may have been made in the? Because sometimes they are posted and I can't see them.
No, I don't see any.
Okay, thank you. Okay, so what remains is for me to thank Athena for excellent presentation, excellent work, very clear presentation. To thank all the colleagues here and people who have been able to give generously over their time and make some comments, and all of you for making the time to be able to be with us for this discussion. And I see quite a number of people from across the world. Good friends, Amidu, thanks for joining us. Peter Wamarwa, yes, great work. We need to do something like that, something along the lines for Kenya, maybe for the other sectors. And next week, we have a seminar extraordinary by our new professor of practice, Dak, and a distinguished panel. So please don't miss the research seminar next week on Wednesday, same time. Until then, thank you very much, and I look forward to seeing you soon. Thank you indeed.
Thank you everyone for your comments and your attention. Thank you.